I remember when Mars bought Wrigley before I got there, but I spent a fair amount of time with that business. And, if you talk to people at Wrigley back in the day, they would say, basically focus on the core and every 5 years launch a new brand for a new generation. And so even back when there was no VC and consumer at all, you basically wanted to sell more of the same thing to avoid cannibalization, but you always needed the next thing, at least every 5 years. And obviously, we're much more saturated than that now. There's much more competition, but usually it's some sort of differentiation around form factor in pet food, right? And on the basis of that, you break through and then you extend the platform and the brand to the other sort of adjacencies that are nearby, whether that's snacks and treats, whether that's supplements, whether that's other types of form factors in pet food. That's the typical path. And I think you'll continue to see that happen just because typically if a big consumer company like Mars is going to acquire one of those companies, Kind Bar is an example, right? You'd acquire Kind Bar for the bar platform, and then you'd extend into all the other things that Mars has, right? And take that brand across categories, and that's what you're paying up for, right? So as we think about consumer, we'd like to see companies that are a little later, almost growth stage, probably at least 10 million in revenue run rate, and as high as we've seen companies pitch us that have over 150. But for us to make money, we generally want to stay in kind of the 10 to 75 run rate range, such that we think there's enough room left and value left for us to come in, get a reasonable price for us and for the founder, help them win, help them get above that probably 200 million revenue mark and get to a point where they can sell, which I think has gotten a lot later than it would have been 2 or 3 years ago, just given how the market's going right now. But that's how we think about consumer. And so that's more on the product side. We like recurring revenue. So pet food's much more attractive to us than pet products, for example, that are more discretionary. On the services side, it's harder, especially the four-wall settings, brick and mortar stuff, I think has been really challenging. Tends to be a lot more capital intensive, more private equity style investments that are late stage. We may make a consumer services investment, but would be biased probably toward marketplaces and other things that are tech enabled that can scale faster, right? So that's consumer. Healthcare clinics, I think, are tough at this point in the US. It's just been so much done. Mars, we did what we did. JB followed, and a lot of PE firms followed after that and drove up prices. And I think there's just been a lot of hard sledding for over the past couple of years. A lot of recaps, a lot of disappointed investors and founders based on kind of what's happened. And some people like the guys at Veg and Steve at Modern, they're doing a great job, right? So I won't paint a broad brush, but I think there are a lot of people that are having a lot of hard times right now.